Good afternoon, everyone, and welcome back to KW Property Management and Consulting's Community Association Best Practices Monthly Webinar. I'm your host, Tim O'Keefe, an Executive Director and Partner with KW Property Management and Consulting. Last month, we talked about creating effective budgets for your association, my favorite time of the year, as well as Roxana, who's with us. We love budgets here. Today, we'll expand on the budget topic and discuss how community associations will tackle getting access to funds, as insurance drastically increases and many properties will be seeking funding for reserves based on the new laws that have gone into place. Understanding your need for cash flow will be a topic today, and we will do a good job tackling that. Regardless of where you are in your association's cash position and the need for funds, you will get tremendous value from our discussion today. Thanks to the Florida State Legislature and the current inflation rates, we have plenty to talk about today. So we received a number of questions from many of you that joined us today before our webinar. So we'll do our very best to address all those questions. And if you have any questions throughout the day, feel free to use the icon at the bottom for Q&A, and we'll do our very best to answer your question. So let's spend our time today discussing how we can identify funds for projects and reserves. We have two very knowledgeable and experienced ladies that are joining us today. So let's get started by introducing our panelists. First, we have Rebecca Prieto. Becky is the Vice President of Finance at Popular Community Bank. Popular Bank was founded in 1893, so been around for a while, and ranks among the top 50 U.S. bank holding companies. Popular is an association banking division, and Becky works with many of the community associations that we manage. Thank you for joining us today, Becky.
Thank you. Thank you for having me. Good afternoon to all. I have been with the bank for over 21 years, lending to many of your associations and across Florida, South Florida. I am the Senior Vice President and the team leader for the division at Popular Bank. So along with me, I do have other lenders that would assist in providing financing to community associations. And we have a division. We're right here in Miami Lakes, and we make all the decisions here in our Miami Lakes office. Excellent. So thank you for having me.
Thank you. Thank you for joining us. And also with us today is Roxana Dorigo, who's an Executive Director and Partner with KW Property Management Consulting. Roxana is not only a CPA, but she oversees our accounting services group with KW. Roxana's used to this. She's used to putting up with me. She does this with me often. So thanks for joining us again today, Roxana.
My pleasure. Thank you, everyone. And as Tim mentioned, it's my favorite time of the year. It's funny to say that it's budget season. We're overwhelmed, but it really brings out the best of our team and the support that we offer associations. And, a couple of years of tough budget years. Next year is also going to be difficult because we're calling it, when we present to our team, we're calling it the perfect storm. We're talking about insurance. We're still talking about payroll, but now add to that the new law and how are we going to fund the different requirements? What are we going to do? And then we have 2 years, for compliance. So yeah, it's an interesting time in our industry.
And it's an interesting day because the Fed has made another decision on interest rates that we'll get into a little bit later today in our conversation and what that impact might be for all of us. We do have some poll questions. If you don't mind, take a peek at the poll questions and answer those questions. We will review the answers at some point. Shelley will push the answers to me and I'll see how you all are responding to the questions today. Roxana, let me start with you. You kind of started in on this, but last month we focused our best practices webinar on budgets, and we're in the middle of those, as you mentioned. So one of the key areas that we need to tackle with boards is how associations will plan and fund for reserves based on the new laws approved by the state legislature back in May. So let's review what that law now requires of associations, if you don't mind, so that we just set the table for, here's where we are, guys, here's what we need to get ready for.
Absolutely. And I kind of broke it down in my head and for our managers as well, with the help of our attorney, 3 different areas, right? There's to take it off the table, very easy. There's if you do need to comply with this law, and those that the condominiums and cooperatives under section 718 or 719 for cooperatives need to file with the DPPR by January 1st, 2023. And the filing is simply to let them know how many buildings you have. Do your buildings, are there 3 stories or higher? In what county do they reside? So they're just taking a poll of all the associations that most likely will have to comply with what is now in the statute. So that is number 1. That's something that was clarified and put into the law. And maybe, Tim, we could send a quick link to anyone online, because it's a very simple 5-minute process that if your association hasn't done it, should be done today. Again, it only takes 5 minutes. The other requirement that came out with the law is the milestone inspection that is applicable to condominiums or cooperatives with 3 stories or higher. And which one of the requirements is if you are 30 years, your building is 30 years or older. Or the other requirement is 3 stories or higher and 3 miles of a coastline and 25 years or older. So if either one of those applies to your buildings or association, then you will be receiving a letter. So just taking a poll of our associations that may meet those age limits and the mileage away from a coastline, we have been receiving the letters, and the associations have 180 days to comply with phase number 1 of the milestone inspection, which is a visual inspection where a licensed engineer, architect walks your building and prepares a report. And if the report identifies any substantial structural deficiencies or deterioration, then there's a phase 2 to that study. And again, a licensed engineer, architect will do a more invasive review of your building, where I imagine they would chip away and look into the rebar, into the concrete of your building in whatever area they've identified as structural deterioration. Also, buildings with certificate of occupancy issued on or before July 1st, 1992 need to comply with the milestone structural inspection by December 31st, 2024.
Let me stop you right there for just a second, because Marcia from Daytona Beach asked the question, what is the time frame for complying with the new law for being fully funded for reserves?
Actually, it's for your budget of 2025. So that's why we're looking at 2 years for compliance. The second or the third requirement and of this new law passed on May 2022 is the structural integrity reserve study. Again, the associations that are required to comply are 718 condominiums and 719 cooperatives with 3 stories or higher. The new the law states that on or before December 31st, 2024, a structural integrity reserve study must be conducted. And that study is different than the one that you may have been obtaining year over year. It is very specific, and it needs to include very specific components: roof, load-bearing walls, floors, foundation, fireproofing and fire protection systems, plumbing, electrical systems, waterproofing and exterior painting, windows, and any other item of deferred maintenance or replacement costs that are in excess of $10,000, and failure to replace or maintain such an item would negatively affect all of the items that I just mentioned above. So that impacts all associations under 718 or 719.
And I know this is a review for many people because they've heard about these rules and laws, but I think every time you hear it, you pick up more, because some key words that you used were, if you're within 3 miles of the coastline. So what does the coastline mean? If you're on a river, is that a coastline? There's argument that a river is not a coastline. The coastline means the ocean. So I think there's going to have to be some clarification in the next legislation as far as what we're talking about and what some of these definitions mean. Also, you said 3 stories or above. So if you're 3 stories, yes, you do fall under this same requirement. Doesn't start at the 4th story. If you're a 3-story building, then you have to do the same thing that a 50-story building does. So
Yes, and I think a good,
no, 3 stories, yes.
yeah. So a good point you just brought up. Every association's different, and although you're going to hear a lot about the law and how it's impacting your association, we always recommend that you check with your attorney as well, specific to your association, your history, and et cetera. So that we know, or what the impact of this law is to your association. I know some of our condominiums, to your point, Tim, where they're on the intercoastal, did get a legal opinion and they said yes to comply. So.
Okay, so a couple of questions that have come in. Rebecca, I'm going to take care of the most important one. Lawrence wanted to know if you're related to Dr. A. Prieto in Albany, who's an electrophysiologist and cardiologist.
No, I'm not. I don't know. Should I be? But no.
So what I'm hearing is you're not the only Prieto in the world. So there's
no.
others.
That's by my husband. So no, I'm not. As far as I know.
Thank you for that. That was an easy one to clear up. Kathy is asking, Roxana, you might know this better. What is an estimated cost for a milestone study versus a structural integrity review study? General cost. Do we have an idea? How big is the building? How many buildings do you have? I mean, there's time and material involved in this.
Yes, and the age of the building. Have you been funding? Have you been doing the projects as they come up based on the remaining life schedule? There's a lot of questions. I can just tell you a building that is 25 years old is borderline on the intercoastal and has been doing the right thing actually year over year, not necessarily through the reserves, but through special assessments. So they're up to date on their major projects, received a quote for the structural integrity reserve study of $22,000. The milestone, I've also heard somewhere in the range of 10 to 15,000.
Okay, so thank you. That gives a range for Kathy. And then I think it's Rich is indicating that windows are responsibility of unit owners, not the association. Not always. Depends on what your condo docs say.
Yes.
But so that's something that you just have to understand what the documents say and understand who's responsible for, walls and windows and some of the exterior things. It just depends on how it was written years ago.
Yes, and I think this brings up a point that the statute as it's written, and I hear it from all parties. I hear it from attorneys. I hear it from reserve study specialists or licensed engineers that there needs to be some clarification on the new structural components. How the funding is supposed to be structured, what is going to be the calculation, et cetera. But there are 2 clarifications coming in December of 2022. That's one. And then they have another chance in December of 2023.
And so we have the same question asked by 2 different people, Roxana. Jerry in Naples is asking this question, as well as Peter on the chat line here. They want to know, what is the definition of fully funded?
So there's a little bit of misconception. I think when you hear fully funded and then you look at your reserve study and you look at the replacement cost, that bottom line, that total of your replacement cost, it could be somewhere between 8 million to who knows, $20 million, depending on your components. And it really, that's not necessarily what is meant by fully funded. When we're talking about budget year over budget year, the fully funded calculation under 2 approved methods in the state of Florida is straight line or pooling. So when we talk during this time of budgets, fully funding reserves, it's what the calculation as a result of either one of those methods is considered fully funded. So if I'm doing a straight line, it's very simple. It's a formula. It basically says I need to have a certain dollar amount for my roof in about 10 years. It gives you a number from a formula, and basically you're fully funding reserves next year by just including that number in your budget. So that is what, when we talk around this time of budgets fully funded, is really the calculation from either method.
Okay, thank you. Marilyn has chimed in here and said that she got a quote for a 30-year-old property on the beach, and it was $45,000 for her structural integrity study. We don't know how many stories that is and the condition of the property. So what we saw was about 22,000. So you can see there's a range, and I think the range is probably fairly $20,000 to $50,000. Those are numbers that I've seen spelled out. Just really depends on condition and the size of the building. So it's a sizable expense regardless of process. The best thing to do is keep your building well maintained, be able to use the milestone study. And if you get through the milestone study and you don't have any major issues and your building's not 25 years old yet, you're not near the beach, then it's going to save you money in the long run if you continue to maintain it properly, because you won't have to adhere to these new requirements until your building is a little bit older. So if you're a 10-year-old building, put the money into doing it the right way for now. Okay. I want to get to you. So when can we get more guidance on the ability to use lines of credit that are in place in funding calculations? This was a question that came in from one of our listeners. So when can we get more guidance on the ability to use lines of credit that are in place in our funding calculations under the new laws that go into effect in December of 2024?
Right.
For me?
Yes. Becky, do you want to handle that one, or do you want, can you handle that? Or do you want Roxana to?
Rebecca, can you handle that one?
Sure. So we are working on a program to assist with the funding of the reserves. Right now, we're going to be very flexible with the terms, but we're looking at perhaps 2 years as a line of credit to convert to a term loan. But again, it's very flexible. We're in the very preliminary action plan. We're discussing with our credit officers. But definitely, we will have funding available for those associations that are interested, okay? And we're going to work very hard. We're going to customize the loans. We're going to be very flexible. We are willing to meet at the properties or meet with board members via Zoom, Teams meetings, and discuss their individual need, because each building is individually different than the other buildings, and they have different needs. But definitely, we look forward to assisting all the associations that come our way.
And so can you also give us a list of items that are considered appropriate for reserves? Like if someone came to you and wanted a loan or line of credit, what kind of items would you look at and say, yes, this qualifies, we would loan money for this type of project?
Okay, for the type of project, what we are provided with a project budget. So there's a lot of things before they come to us or during the beginning stages. You need to hire an engineer company to do an inspection of your building. We're going to ask you for a reserve study to see what components are going to be due within the next 5 years. But there's also the changes of laws that we're going to be working with. But absolutely, we look at all the components. We look at the useful life of each of the components to determine the number of years that we can finance. We also look at the increase per unit. How much is the units are paying right now in their maintenance payment, and if they have a special assessment in their special, and how would the unit owner be impacted with a new financing?
Okay, and so Roxana, you might be able to help with this one. Andrew in Naples is asking, what is legally required and what is simply good practice for reserves, for putting in, money into capital reserves for what items?
So what should an association, I guess, put into
Because the law is
I mean,
changing, so what's legally required is going to be different now moving forward, because like, what are the items that belong in reserves? How should you, what do you put in the reserve bucket? What do you put outside the reserve bucket? Because you listed the 10 main things.
Right, the 10 main things that now have been defined as structural reserve components. Before, some of those items like roof, exterior painting, fireproofing, fire life safety systems were already part of, let's say, 95% of reserve studies, because they met the criteria of being a reserve, and that is any asset or deferred maintenance that has a useful life greater than 1 year, and greater than $10,000. I don't know why they put 10,000. I think that's been a discussion too, but that's what a reserve study is, or that's what a reserve component, excuse me, is. Now there's just two separate categories. There is now structural components and other components. So that's what the new statute has clarified and made a distinction. So for the structural components, which I mentioned earlier, the roof, the painting, fireproofing are items that should already exist in your reserves. The new ones that are, let's say 95% of the time have not been in a reserve study are the load-bearing walls, floors, and it's not the covering of the floor, it's the subflooring, it's the actual structure, foundation, plumbing, electrical systems, and windows have typically not been in a reserve study. Now they are.
So we talked about this last month with things like load-bearing walls and foundation. Like, how can that really be part of the reserve study? Because look, if you've got to replace that every so many years, you got to shut the building down. Everyone's got to move out if you got to replace load-bearing walls and the foundation. So I think that we need to see from the state legislature this year to clean some of the language up, because some of it just doesn't seem practical from my perspective, but that's what the law says today, at least fund for.
True. I mean, I think that's been a discussion of what is the amount, what is going to be the replacement. And what I've seen in the 5% of reserve studies that have included plumbing or electrical, there's an allowance that was placed in the reserve study for structural items. So that might be a clarification. We don't know yet.
So we have a number of questions around reserves. I think I want to get to that toward the end. I want to move forward and talk more about how we get funding for reserves. We have questions about pooled versus a straight line reserve. So we'll attack that here in a bit. But let me start with you, Becky, on questions around funding. So what are the sources of funds most often needed when a community association approaches a bank for a loan or line of credit?
What is the sources, the projects that they actually need money for?
Yes.
Typically, the 40-year is very popular. The 50-year, impact windows, the roof, concrete restoration, those are the typical, the balconies, those are the typical purposes of associations coming and applying for loans.
And that 40-year is going to change, because the 40-year only applies to Miami and Broward counties, because that's no other counties in the state had that requirement. Now the entire state has the requirement, but it starts at as early as 25 years. Yes. And then it's every 10 years beyond that. So
that's correct.
That's all going to change. So the need for money could happen much quicker unless everybody gets fully funded, and they might need the money to get fully funded through a line of credit or a loan anyway. So I think we're going to start to see things change. And I'm sure the bank's picking up volume and activity very quickly based on these changes.
It's already happening. It's been happening already. And I also want to include, because I just got my approval, we're going to be able to assist associations to fund the engineer report or the research studies. I was just given the go ahead and mention that in our presentation this afternoon. Okay. So definitely we will have funding for the engineering report, which can be costly, and the research studies.
So when does it make more sense, Becky, to get a line of credit versus going straight to a loan? Lines of credit eventually become loans, but when do you approach the bank and say, does it make more sense for me to start with a line of credit, or do you just get a loan right now?
Well, my question for the associations when they come and ask me for a loan versus a line of credit is how long is the project going to take from the beginning to the end? If it's going to be a shortly, 3-month project, I will recommend having a term loan. Why? Because a term loan, the interest rate is going to be better. It's going to be lower than if you have a line of credit up front. With our bank, we do lock the interest rate for both the line of credit and for the term loan up front. So, we're taking all the risk by locking the rate up front, not knowing how much the association is going to use or not. So to answer your question, I would first ask, what projects are you entertaining to be funded? And how long would the construction period take? And
And so
depending on that,
so
yes,
when we approach you, or the manager approaches you, or board approaches you with the need for funds, there's going to be an application that needs to be filled out. What information should a property have prepared in advance, if possible, so that it makes the process move faster?
well, we just started, I'm glad you're asking this because we just started online application process. It's going to be user-friendly and much easier. I'm not going to be sending our data sheet, which is one application, and you complete it. No, you go into online and you fill out all the questions, and we have all the preliminary questions that are needed in order to provide you with a credit decision. And on that same application, you can upload all the financial information. No longer have to be sending emails back and forth. Everything is done user-friendly online on our application, our new application for loans. And I will be sharing that with KW very, very soon because we just started using the application. Okay. Now, if there are unit owners that are afraid to use the computer, no worries. All you do is you give one of the team members a phone call and we'll help you through the process. Or if we have to do it by the application to help you start, we will. But we're very flexible and we're here to assist.
And with KW, it's actually our job here at corporate. The accounting manager that oversees the account actually does the application, puts together the financial, and then presents it to the board for approval before it goes to the bank.
Well, that's a great service.
You're gonna love the new app.
It makes it easier for the manager too. So
Yes.
that's a nice.
And you know what? You can start it, and let's say something you have a meeting to attend or something, you can come back to it later and complete it.
Okay.
So I think it's very good.
So is that ready today? Because Jose is asking, what's the online application link? So is it ready today, or are you still
It's
working
ready
on it?
today. Can I send it to Roxana in a little bit?
Sure.
It's ready today.
Okay.
Okay.
And we can, so one of the things that we do at the end of the webinars, for many of you that are on regularly, you know this, we send out the recorded session. So we can add a note. Shelley, if you don't mind, we'll add a note with the link to the online application for any of those folks out there that want to move straight to application. Then that would be available, and we'll make that easy for you to get there. Okay. And then what information should a property have available to help expedite the process so that they don't start, oh, I didn't know we needed these 25 things. Let me go start looking for them. And it takes a month and a half to pull everything together. What would you be looking for, basic things that an association have mostly available?
You would upload the budget. You would upload 2 years to audited or reviewed financials, depending on your revenues. It would be an accountant prepare or a management prepare year-end financial for 2 years. The most recent interim statement, the balance sheet, and the income and expense. You would provide an age accounts receivable report. Now, we don't like it on the 31st of the month. We just try to give credit to those people that are past due 30 days. So we ask for any days but the 31st of the month to help you get approved. Sometimes we have associations that it does help. We ask if you have a copy of your reserve study, your governing documents. Let's see, very important. Your rental log, or if you have a unit owner roster with mailing address. All those documents you would upload, and you can see it. I'm gonna try to get, before we end this call, I'm gonna get you the application link so I can share with everybody that's on this call, okay?
Okay. And then also, I think you might have mentioned it, I might not have heard it. It's always good to have your accounts receivable aging report. That's always a big thing. You like to see what, if there's
Yes.
delinquency.
If you pay your bills, then you will pay our loan. You will repay our loan. So yes, we
speaking
would
of that, so what's collateral? What do you use for collateral for a loan?
it's an assignment of assessment, meaning the future cash flow of the association. And it would be both the maintenance, the regular maintenance, and the special assessment associated with this project, with the projects.
So board members may not know this, but when you enter into a loan, if everybody in the association decided to stop paying, then the bank can step in front of the association to get that money when it comes in, right? Because that's the collateral. That's what you're saying the collateral is.
That's correct. And again, I've been in this industry for 24 years, over 20 with my boss, and I can tell you that we've never had any association past due 30 days. It's the unit owners are not going to lose their unit because of a special assessment. Okay.
And so the good news for those that may not realize it, but living in a condo, you're a very good, from a risk standpoint, you're a very good customer for a bank because you've got steady cash flow from the maintenance fee that are paid monthly or quarterly, and the bank can just grab those if the fees aren't getting paid back to the bank. So you're very good from a risk perspective. Let's talk a little bit about structure of financing a loan, if we could, Becky.
Sure. I'm just putting the link here in the chat so everybody can see it.
Awesome. Thank you.
Okay. There it is. I just sent it. So can you see it?
It hasn't popped up yet.
Associationbankers.com.
I see it.
Oh,
okay.
Okay, there it is.
I'm not very techy on computers, so I apologize. I like dealing face to face with my customers, but when it comes to computers, I'm not sure. So I'm glad you can see it. So you wanted to talk about the structuring of a loan.
Yes.
So typically, the lines of credit are offered depending on how long the construction period will take. If the construction period takes a year, we can finance a line of credit for 1 year to convert to a term loan. We can go up to 2 years. And in some exceptions, we've gone over 3 years on the line of credit. But I would like for you to keep in mind, because we lock the rates for you for the line of credit and the term loan up front, the longer you go on the line of credit, the higher the rate is going to be on the term loan, because we don't know where rates are going to be a year from now, 2 years from now, 3 years from now. I don't even know what the rates is going to be 6 months from now. I just heard that prime went up 0.75 today.
I bet you dollar it's going to be higher in 6 months from now than it is today, though.
We don't know. So that is best that you don't go so long on the line of credit. We like to keep it to 18 to 24 months. We give you the option. You don't lose on the availability of the line of credit at the end of the line of credit. So when you get to the maturity of the line of credit, if you haven't completed your projects, you don't lose the availability on those funds. You can take all the monies that is available on the line of credit, and we can go ahead and put it into an association account called Loan Proceed. We will subtitle it Loan Proceeds, and we will place a hold until you're ready to go ahead and pay the vendors. So that's great because we lock the rate for you up front at a better rate because it's 18 or 24 months. We lock the rate for the term loan, and at the maturity of the line of credit, you can take all the funds and place it into an association account with a hold.
How long does it normally take from beginning to end, from the time you call and say, Becky, I want a loan, versus until the loan is approved and assigned to the property? What's the normal time frame if there's such a
From the beginning to the end on the entire process?
Yes, ma'am.
I would say 30 to 60 days.
Okay.
But it all depends, on everybody's part, because, some associations, they change board members, they think differently. They have to send all the documents to their attorney. They have to review the documents. There's a lot of things. A unit owner vote may be required by the governing documents, and that takes a little longer. But I've closed loans in 30 days when it's been an emergency. I've closed it. But typically it's 30 to 60 days.
So you made a good point that I want to reference because we do call this best practices for community associations. Have your attorneys review these documents.
Absolutely, they have to. Not only do they have to with us, not only do they have to review the loan documents, but they have to render an opinion letter on behalf of the association in order for us to close on a loan.
Okay, that's important. What else happens during that 30 to 60 day window of getting the loan put in place? What other key milestones happen in your process?
Well, we gather the financials. We make sure that it looks good and that it's going to be approved prior to submitting it to credit. Because that's my goal. My job is to make sure we get the loans approved. I do speak to board members, finance committee members, because every association is different. Every association thinks differently, and they may want something different. Maybe a higher rate is not as bad as paying a higher fee, or the depository relationship, all of that. We have to make sure that it works for both the association and the bank. Then it goes to credit. Immediately once we have the entire package and I've reviewed it, it goes to credit. And credit takes about 10 to 15 working days normally to get a credit approval. There are sometimes that they don't have that many requests and they can do it sooner, or there may be delays, or if the request is a complicated request with some hairs, we still try to make them happen, but we have to work through those situations to get it where it's going to be a decision. And I look at all that to make sure that I know that when the loan is sent to credit, it's because it's going to be approved.
And when you're reviewing this documentation, one of the questions that Marilyn's asking is, what's the maximum percentage acceptable in delinquencies that you would still make a loan for somebody?
Okay, typically we don't like to answer that because we don't like to give a recipe out there because there could be bankers on the call. But I can tell you that we are one of the highest. We allow the highest delinquencies, and we only look at the delinquencies past 1 year. We don't go over the 1 year, so that helps a lot. We also look at the delinquencies, and that's why we ask for the report as of any day but the 31st of the month to help. So we have ways of making it work for the associations. I also work with many associations and I ask them, send me just a few of the financials. Let me see where the weaknesses are. Let's see how we can work towards getting these weaknesses to be strengths, to be good. And then I help them put those loans through. There are many associations in my portfolio that when they first came, there was no way they were going to get a loan, but we helped them through it and we made the loans and they paid, thank God.
Yeah, well, and I would say this from an overall perspective in the market that we're in today, delinquencies haven't been a major problem. So what we're seeing, and Roxana, you can nod your head if I'm getting this wrong, but we think that delinquencies really should be below 5%. Yes. And if you're above 10%, you've got a collection problem. You need to work on your collections. You should not be over 10% in the market that we're in today. And quite frankly, you shouldn't be over 5% if you're doing the work to collect from anybody. I'm the treasurer of an association that I have for a condo. And my manager sent me a note earlier this week about we're sending this person to lien. I said, don't send them to lien, send me the phone number. She sent me the phone number. I reached out to the guy and our association changed to a lockbox. He didn't know who to pay. He's been living in the unit for 12 years and we were going to send him to the attorney. And he's never missed a payment until the last 3 quarters. So I reached out to him, told him, I really need you to pay us. Here's the reason why. I'm just your friendly neighbor, your treasurer. I don't want anything bad to happen to you. It gets really messy if it starts going to lien and to attorneys and you have costs. So he got it paid yesterday. It took 24 hours and he made the payment. So it's not difficult to assist with collections. Like call people, be friendly, let them know what's going on. If they push back, then you take a tougher position with them. But do your part as the association to try to collect from people if you don't know why they didn't pay.
Yeah.
Everybody has different situations. We have challenges going on right now. So,
Yeah, I was
but
going to say that with the increases in these last year into this year and now from this year to next year, that's certainly something that we're looking at very closely. And it's about having the collection policy, establishing that. If you haven't, across our associations, we have an average of 2%, 1% to 2%. Some are zero delinquency. But it could get away very quickly because the minute there's an increase now, the average from last year to this year was somewhere between 12 to 15%. Next year, just looking at preliminary numbers, it could look again like a 10 to 15% increase. And eventually there's going to be some owners that may not be able to pay. So we need to capture them in the first month of the quarter or the first month that they are delinquent. You need to immediately address it from your collection policy and make it active and really truly hold that collection policy.
Great.
So what Tim just said, our delinquency guideline is a lot higher than what you guys have mentioned. So you guys are doing very good, and it's a good way to keep it as low as Roxana and Tim have said. Absolutely.
Right. If you stay in those ranges, you're going to be fine getting a loan. That's what we can say. Okay.
You'll be approved. You'll be approved.
So I'm going to fire some questions at you, Becky, so you can answer these as far as working with the bank. Does Popular Bank, if I'm going to work with you to get a loan, do I have to have an operating or reserve account open with the bank in order to work with you?
We're not going to require that all your accounts are open with the bank, but we're going to ask you what depository relationship you feel comfortable in maintaining with our bank. I mean, if we're going to start a relationship and we provide you the funding, we should be entitled to have a deposit account. But we don't require the entire account. You tell us how much you feel comfortable. And just keep in mind that one of the keys for the interest rate is the depository requirement. So, the more you keep with us, the better rate I can provide you. But we do not require all of the deposits.
So speaking of interest rates, when's the best time to lock in on an interest rate?
I would say locking it as soon as possible, because we've had a lot of increases. I mean, prime already is at 6.25. Today, prime is 6.25. So we've had many increases.
And the tendency looks like we're in an environment where interest rates are going up, not down. So if you think you need a loan in 3 months or 6 months, it's probably better to get in today because you'd likely get a better rate than what you could if you wait too much longer. Tim,
with that said, I'm sorry to interrupt you. We lock the rates for 60 and 90 days up front. There are many other banks that may lock the rate for you, but they lock it at 5 days prior to closing or at closing. We will lock it for you. Let's say they come today, we'll lock it today.
That's significant. That's a very, very good point. Thank you for mentioning that. And then does the bank have a prepayment penalty?
We only have a prepayment penalty. We only have a prepayment penalty if you marry me today and you decide to divorce me. You can prepay with your operating account, with your special assessment account. If we know ahead of time that you have a claim with the insurance and you win that or 558, then we will allow you to prepay with the monies that you receive. But you need to tell us ahead of time. So when you do get your monies, we allow you to prepay. There's only a prepayment penalty if you decide to go to another bank. And it does not include if you refinance with us, because we're not going to want to lose you as a customer. So we will work with you if you want to refinance with us.
You compared it to a divorce. They say divorces are expensive. So I guess it's that much so.
It is expensive. That's why, it's expensive. That's why I mentioned that. Yes.
Yeah. Okay. So what is risk rating and how do you use that when you're deciding on making a loan?
So I'm glad you mentioned that, because how with the competitive that we are now and everybody asking for loans, we ask for 4 financial documentations to be uploaded with the application information, because what we do is we have a formula that we have to plug in certain example, number of rentals, the deposit, the cash position of the association, when the building was built. There's certain credit ratios that we need to know, and the result is the risk rating. The risk rating is part of your interest rate on your loan. So to quote you on the rate on the loan, we're going to look at the amount that you're applying for. We're going to look at the terms, how long the line, how long the term loan. We're going to look at your cash position. We're going to look at your rentals. In other words, we're going to look at the risk rating of your association. And once I have that risk rating, it's going to be applied with Treasury, and then Treasury will give us the rate. So what I have been doing lately, I've been trying to get the 4 financial documentation ahead of time. So when I lock the rate for the association over 60 or 90 days, that's the rate that you're going to get, because when the credit is approved, they approved it with the risk rating that I approved the pricing. So it's important. It's important to get me certain financial documentation, such as the budget, the year end, the interim, and the aging. And then I need to know how many units are in the building, when it was opened, and what's the rentals. Those are the only things I need to get a risk rating. And that risk rating, I give it to our Treasury department. And from there, they give me the lock rate that I can provide you.
So how does that impact interest rates? How does the risk rating impact the interest rate then?
Oh, it impacts it. It impacts it. There's a grade between 5 and 8, let's say. And if you're in a 5 or a 6, your interest rate is going to be much better than a 7 or an 8. So it's important to get that ahead of time. Okay. And I do that with all my loans. So when I give you a term sheet, that interest rate, we're not going to have an issue.
So if I come to you and say, Becky, I need a loan for my association, how long can I finance this? And you're going to ask me, well, what's your project? How long is the project going to take? How long is that asset going to last once you put it in place? So the roof, concrete restoration, there's different pieces, a cooling tower, they all have useful lives, right? And then how do you use that to create the length of the loan?
Well, that's the first thing we look at. We look at the components, and we look at the useful life of the components. For example, a roof can have a warranty of 15, 20 or longer. So there, if you can prove that, we can go long-term financing. I don't want to say very long, because Roxana doesn't like very, very, very long-term loans. I have to say flexible. We are flexible. We'll talk to each building, each board, and among us, together with your management company, we will see where is best for the association, how long to finance. But we are very flexible, and we do provide long-term financing.
Roxana?
Does that answer your question?
That answers it for me, Roxana. How long do you think is an appropriate loan for a project?
5 to 7 years. But
okay.
To Rebecca's point from earlier, and what we've been saying is that every association is different. Like we were just talking this past week about association. Well, they have a lot happening. There's a special project already. Now they have to comply with this new law. There's a potential $25,000, $30,000 on reserve studies alone. And so you have to now maneuver and do the best for that association. Does it make sense to increase their 2023 by 15%? They already have a special assessment. And then to burden the association again with new special assessments and having that a short term, well, it may not make sense anymore to do a 5-year. It may have to be a little longer term, 7 to 10 years. And that's the nice thing about you, Rebecca. I know you work very closely with the association. You do measure those type of things. And then at the end, we present options, right? You present options. There could be a 5 to 7 year option. It could be a 10-year option, maybe slightly over 10 years. And your bank has been flexible in that sense.
Yeah, and sometimes we have to do it longer. We don't want to hear that, but sometimes we have to do it longer because the increase per unit is outside of our credit guidelines. We want to make sure that the unit owners do not get in trouble. I mean, there could be health issues. People can lose their jobs. We have to take all of that into account for the associations to do the repairs, but also to afford it.
So Becky, I'll put you on the spot with this question. So if you look at interest rates today versus where they were 6 months ago, if you can recall back 6 months, where have you, like, let's assume a financially healthy property with a good risk rating, where would interest rates have been 6 months ago versus where they are today?
Well, rates were in the 3s and the 4s at the beginning of the year.
Okay.
You know, they were in the mid 3s to maybe mid 4s, but now just prime alone is 6.25. So, I mean, when I started banking 40 years ago, I remember rates were in the 18%. So, I mean, they're still not as high as that time, but they are increasing. They are increasing.
Right. So I get to, this is my, I'm going to become an economics professor here for the next 45 seconds. So this is what's happened. The Fed has increased interest rates today by 75 basis points, which is 0.75%, 3/4 of a point, okay? And so today's increase takes the central bank's lending rate from 3.0 to 3.25. That's the highest the Fed fund rate has been since 2008. That's also the 5th rate hike this year and the 3rd consecutive increase of 7.75%. We've been in a period of inflation, which is basically too few products for the amount of dollars available to purchase those goods. So that causes prices to increase. By increasing interest rates, the goal of the Fed is to slow down the economy and slow down spending, which will hopefully eventually have an impact on lowering prices at some point in time. We're seeing the price of homes starting to come down. Home prices we've seen come down by $50,000 on some houses already, and they should continue to drop, especially with this increase, because there's not going to be this flurry of people. Unless you're a cash buyer, you're likely going to wait it out until the market starts to come down and that you can get better interest rates. The Fed does have 2 more meetings this year and expects to raise interest rates 2 more times. The next meeting, we expect to see an interest rate increase of 0.75%. And at the second meeting before the end of the year, another 0.5%. So if the point behind all this is if you need a loan for reserves or for projects, you may want to get it now, because if you sit out too long, a year from now, it could be, much higher than it is today. Maybe in 18 months, it'll come down. We don't know, but just understand what's going on in the market so that the economy is moving very quickly right now. And you need to make decisions, because we do have this new law coming up. There's the end of 2024. We want to get fully funded for reserves by the 2025 budget. So you got to figure out how you're going to get that money if you don't have it available. So that's my economics, and my economics professor in college, Dr. Wasfi Iskander, would have been very proud of me right now for what I imparted on you. So Google's a wonderful thing. It almost made me look smart today. But Roxana, with that being said, and we know we've got, interest rates going up, and if you're going to get a loan, like what's the best approach to take for figuring out what your rates are, and what are your options? Like, what are the options board members have for creating funds to be fully funded? And I asked that question because according to our poll, one of the questions is, your association currently have a loan to address the cost of special assessments? 18% yes, 82% said no. But in asking the question, is your association fully funded for reserves? 36% said yes, and 64% said no. And I always question the 36% that said yes. If they really do the study, will they be fully funded? And then the other question is, what options will you implement to fund reserves by December 2024? And 77% have said increased maintenance fees, 39% say special assessment, 18% say they're going to look for a loan.
Yeah.
And then the other question that we asked was, does your operating account cash balance equal 2 months of operating expenses? And we have 62% said yes, and 38% said no. So I may have answered the question already, Roxana, but what are the options associations have for creating funds?
So one, your operating fund, right? So the impact of this law is really on professional fees, if you think of it that way. So if you've been putting away or a certain dollar amount for legal fees, for engineering fees, just for general matters, now you have to increase those into your next year. The other is, of course, reserves and how to build that up. And again, every association is different, so it's not a recommendation I would say for everyone, but if you have not been fully funding, so I do have a few of those in our portfolio, and they have not been fully funding. With the new law, the structural integrity study and the components we talked about, those very specific components, can no longer be waived or partially funded. You have to fully fund whatever that calculation is for those structural integrity components. What does that mean for this type of association that has not been fully funding reserves at year over year is that you're going to be short. Either you're going to increase your maintenance fees over a certain dollar, a certain percentage, possibly over 20%. Now, what are you faced with? We have to do a little bit of a balance and say, but what if we had a special assessment at the time that we're calculating your fully funded reserves, and that's funded with a loan? So now we're extending that from a 12-month budget to potentially, it could be 18 months, it could be 24 months, a 3-year, line or loan. So it's allowing the month-to-month fees not to increase by 25%, but maybe at a slower rate. The special assessment, though, to this scenario has to have passed before your operating budget is passed as fully funded, having that source of income coming in from a special assessment. So that is one caveat to funding with the reserves, to fully funding calculation. If you put in special assessment, that special assessment will have to have been passed already in order to include that amount.
Okay, thank you. We only have a few minutes left. Believe it or not, this hour just has flown by for me. I hope everyone else.
Tim, I also want to add, and I'm sure Roxana has in the past, but there's also the insurance increases, and that's really also all at the same time, like Roxana said at the beginning. It's not only the reserves and the projects, but also insurance is increasing big time. We do have financing for the insurance. We have financing for the projects. We have financings for the reserves, and we have funding for the contingency line of credit for emergency purposes, such as a deductible for insurance. Okay, I just wanted to keep that in mind that we have that.
That's a great point, because a lot of associations have just a typical practice to finance their insurance on an annual basis. More may be doing that, I would expect, with some of the significant increases. We're seeing increases anywhere between 25 to 100% with many of the condos, and that's going to have a significant impact on the ability to pay for those the insurance policies. So getting financing for that could be an option for more and more associations. A couple of questions for you, Becky, that have come in. One of them came in from Fred. He's asking, if interest rates go down, do you reduce the rate of the loan?
Yes, I answered that earlier. We're not going to lose a customer to another bank. So we're always going to work with our customers. The rates go down, we're going to work with them. Now, remember, we're locking these rates for a long term. Hopefully, if it's a shorter period, it's better for the bank. But we will always work with our client. We don't want to lose any of our customers.
Okay. And Jerry's asking, the definition of cash balances is somewhat confusing. So how does your bank define operating cash balances?
Operating cash is the monies that you use to pay your day-to-day bills. Is that the kind of question you're asking me, or?
Yes.
Yeah, the operations money is just the in and out of the monies to pay your daily bills. And then you have your reserves, you a savings account for the reserves.
Okay, and Roxana, what's our definition of a financially healthy property relative to cash balances?
So we always measure against 2 months of the average operating expenses. So what does it take to run your association, bare minimum, right? So it doesn't include the one-time leak that happened, we actually take that away. And we really are focused on what does it take to turn on the lights, run the water, pay your normal day-to-day contracts like landscaping, management fees, so we look at that as a measure of financial stability.
So to make the math simple, if you had a budget of $1.2 million, you'd have a operating expense of $100,000 a month. So having $200,000 of operating capital is what we would consider a financially healthy property.
Correct. Yes.
Okay. So,
And the bank goes further by deducting prepaids. We deduct the special assessment monies to see how many months you have of operating cash. We do deduct the prepaids and the special assessments when we do our cash position for the association.
And then there were a number of different questions. I'm going to throw at you, Roxana, and then we got to wrap up because it's 4:00. I want to respect everyone's time. There are a lot of questions about pooled reserves versus straight line reserves. And Janet was asking the question, if you have pooled reserves, you need to be fully funded. And so talk about, like, more globally, what does the new law require as far as pooled versus straight line reserves? And it really doesn't matter if you're pooled or reserved. You have to fully fund. You have to fully fund.
Yeah, so both methods are still allowed. There's been no adjustments to that. And fully funded is just the calculation out of either one of those methods. So both are still, you still can create the fully funded within certain parameters with the pooling and the straight line, but no change thus far.
Karen asked a question, and there's a task force. The task force has recommended straight line reserves for these structural integrity reserve study. It's been recommended, not been made part of law at this point.
Correct. And I think the reason why they were thinking, and I have heard this from attorneys, is that the language in the statute states that you cannot waive, you cannot partially fund, and you cannot use funds that you put into the structural reserve components for anything else. So that starts sounding like straight line because it's not a pool of money. Straight line is very much limited to a certain dollar amount for each component. So that's why it starts sounding like straight line, but that has not been defined and confirmed yet.
Okay, thank you. Well, we've gone beyond 4:00. So let me ask a final question for both of you, and I'll start with you, Becky. Best practice for ensuring that properties can get loans and to maximize their spending so that they're not going to end up with higher interest rates. What's the best way for an association to need for funds today to keep to manage their costs as best possible with this market that we're in with escalating interest rates?
Definitely, you need to go and get your engineer report. Go to your experts. Go to your attorney. Go to your accountant. Go to work with management and make sure that your building is, first of all, safe. And if you need the components done, hire an engineer. Do your reserve study because, with all these new laws, everybody's going to be reaching out to engineers, to limited engineers that we have, and to the reserve study. So the sooner you start, the better. But that would be your first step, knowing what exactly needs to be done in your building, what monies you need to start funding your reserves. And then with that, I'm always here. You can contact me and I will help you through the process for a loan.
Okay, thank you. And same question for you, Roxana. How do we help maximize the dollars people are going to be spending in the future and what they need for cash?
So look at your cash position. I think that's important as we go into another year of increases. Always be mindful of where you are with your cash position. Your delinquencies play a huge role. So one day you may have a good cash position. The next month, if people are not paying you, that cash position goes away. So be mindful of your collection policies and reserve. It's not going away. I've been asked is this real? And I said, yes, because this is a law now. It's been codified. I've learned that word into the statute now. It's set in stone, and I would do it sooner than later. If you have not been fully funded, I would definitely consider that for 2023 and get in line for your structural reserve study. So put those funds, those dollars into your budget in 2023. You need to be in line with all of the, 30,000 associations in the state that we're going to be looking for this type of study. And one thing that we're doing during this time for our associations is comparing the dollar per square foot of their maintenance fees. And why is because they're hesitant to increase their fees and trying to find ways. But, as I'm going through this, everybody's assessments are going up. The associations are not singular anymore. They're all increasing an average of 12-15% over the years. So do the right thing for your association. Start in 2023. I would not wait.
Great, thank you so much. And get on the schedule of your engineer to get the reserve study done, because there's a finite number of engineers out there, and it's best to get on that calendar so that you can get the work done early, get that done sooner than later, so then you can go get the loan that you might need. That would be my best practice for today. We had a great session today. Ladies, you were fantastic. You made it fun for me. You made it easy. This was a great session. Hopefully everybody on the call got great value from the discussion. I want to especially thank Becky Prieto, Senior Vice President with Popular Bank.
Thank you, Becky.
And Roxana Dorigo, Executive Director of Accounting Services for KW.
Thank you, Tim.
Good luck to all board members as you finish up your 2023 budgets. Be sure to rely on your management team as well as your attorneys and your bankers to help get the right answers for you. Many thanks to the hundreds of Florida residents who signed up for today's event. If you weren't able to make it, we will be sending this to you tomorrow, no later than tomorrow. We record this session. You can also go to our website at KWPMC.com and our YouTube channel, which is KWPM TV. We look forward to having you join us again next month as we continue to talk best practices for community associations the third Wednesday of every month from 3 to 4 o'clock. From all of us at KW Property Management and Consulting, be respectful to your neighbors, stay healthy, and have a great month. Thanks, everyone.
Thank you.
Bye-bye.
Bye-bye.